Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hello, I'm Daniel Snyder. Welcome back to ETF Spotlight. Today, we're joined by Mike Zaccardi, a Seeking Alpha analyst, who is here to talk about the overall market trends, what he is expecting for 2025, and then we're going to dive into a couple ETFs with him. So stick around. Now, Mike, thank you so much for joining us today. I want to go ahead and just kick things off with what are you expecting for this new year?
Yeah, well, we're coming off, back-to-back 20% plus gains in the S&P, first time since 97, 98. And there's high expectations. If you look at sell side estimates for this year, they're, the most bullish they've been in quite a while. If you recall, this time last year and then in 2023, the strategists were calling for really muted gains in U.S. large caps. Different story this year. We've got a median S&P price target about 6,600 for 2025. We've got top end of those with a 7 handle. And we're off to a rocky start. So the market's got its work cut out for them to live up to those estimates. A lot's going to hinge on this upcoming earnings season. We're in it. And then, end of the month, we'll get tech reports rolling in for Q4 together with the earnings numbers and the commentary from executives. We'll have a pretty good beat on, where things stand, at least for the start of the year. In terms of economic data so far, we got a hot jobs report, but average hourly earnings within that report were pretty mild. So that should have been kind of like a Goldilocks kind of report, but of course the market eventually sold off on that. Some folks have pinned the kind of weak performance, especially out of tech in the last couple of weeks since the start of the year, to taxes. The notion that a lot of investors wanted to defer taking capital gains to the new year. And as such, we've seen a lot of your big winners from 2024 underperform. And then it's as if we've seen a rotation into last year's laggards kind of perk up as the year's gotten going. Energy, materials, some spots in healthcare have done pretty well. So there might still be some of that going on here in the next couple of weeks. And so, that could be a bit of noise. If we don't see tech start to, come back with some, outperformance after this month, that could be a bit of a warning flag. So there's a lot going on.
So I'd like to double click on the employment trends, right? Some people believe the data, other people don't believe the data. What are you kind of interpreting from the continued jobs reports? And it seems to be dictating, right, a major factor at least as to how well the economy actually does as interest rate cuts continue to get pushed out further and further.
Yeah, I think on net, the labor market is decent. There's just nothing really happening under the surface. We have hiring levels are still are fairly low, but there's no layoffs going on. So you look at your weekly jobs claims numbers; those are super tame. We might even print under 200,000 in the next couple of weeks, which would be pretty remarkable given given what the fears were in Q3 of last year on the labor front. So yeah, just not the churn right now is so low. What was kind of interesting in the December report was we had a bit of a congruence in the establishment survey, which is used to figure the unemployment rate, and then also the household survey. So when those two align like that, it kind of gives a little more confidence on what's going on. and actually the household survey determines the unemployment rate. The establishment survey is what gives us the payrolls number. So those two numbers were both pretty strong, and that just lended further evidence that hiring is probably pretty strong to end of the year. And we had a material downtick in the unemployment rate. I mean, it dropped 15 basis points, which is a pretty healthy number. And you can look at some of the employment readings within the PMI reports. Those have been okay. I mean, it all just kind of points to, I've been kind of writing about a good, not great employment situation. And I don't really see that changing anytime soon. I mean, we'll probably have, I would expect, 150, 175 a month on average this year in terms of payroll growth. You have to keep in mind that we're still kind of working off some weird effects from the hurricanes late last year. And then we had, some one-time layoffs that were going on, like Boeing in Q3. So they were still kind of working out some of those kinks. And now we're going to have to deal with what's going on with the LA wildfires. That's going to impact California, which is, of course, a huge chunk of the employment market. If you were just to take California by itself, it'd be one of the top GDP countries in the world. So that's going to have a material impact on the January jobs report, which we'll hear about on the first Friday of February. So, you just kind of step back though and look at the overall trends. This a large drop off in employment trends. We just haven't seen it, and to me, there's nothing really suggesting that's going to happen anytime soon.
Mike, I want to ask you about, I think it was a few weeks ago, I saw a report, I believe it was Goldman Sachs that put it out. That said equities are priced for perfection. What are your thoughts on that?
Yeah, so we've got the S&P right now at about 21 times earnings. They're about maybe a little bit under that now with the pullback to start the year. And then as we kind of move out on the timeline curve, we kind of have a period shift in earnings. So, the longer we go through time, the better the PE looks, all else equal, just because we're running at a really solid clip of year-over-year earnings growth. So, Goldman came out last year suggesting that based on the multiple today and historical trends, we shouldn't expect really high compounded returns in the S&P over the next decade. So they're thinking like 3% total return on the S&P, which of course would not be very good, especially in light of the last 15 years. So, and they haven't backed off on that. They, at the same time though, they're much more bullish on the prospects for the S&P 500 equal weight, as well as small and mid cap stocks. So that's really kind of it's kind of like a cookie cutter valuation call on kind of longer term capital market assumptions. A lot of people do that, like Vanguard, GMO, JP Morgan. They all kind of use the same kind of metric to when they're making those really long term forecasts. A lot of it's based on what the current valuation is. So it shouldn't come as too big of a surprise. And if anything, it should be kind of a welcome thing if you're a diversified investor, is kind of sticking out with an asset allocation approach to mid caps, ex-US, and value stocks too. I mean, you got to consider that the median S&P 500 PE multiple is only about 17 or 18 right now. So, certainly not stretched by historical standards. And if you look at the global market, you're looking at low teens earnings multiples. So yeah, while we have pretty high PEs in the Mag 7, there's definitely pockets of absolute value elsewhere. But I mean, you can also look at it from the perspective of like a PEG ratio approach, which is something I like to do a lot in my single stock analyses on Seeking Alpha. I'll take a look at the PEG ratio, which is, of course, the price to earnings divided by the growth rate. So it kind of factors in growth expectations into a PE. Because, of course, like we all have a calculator. We all know that like a 30 PE stock sounds pricey, but if there's also a 30% growth rate baked into that, that's a PEG of 1, which is a pretty good GARP, growth at a reasonable price valuation. So if you look at the growth rates on the Mag 7, they're still going to be very strong this year, still expected to outpace the earnings growth of the other 493 in the S&P. So that's where you're getting a lot of your earnings growth. You look at a long-term chart of S&P 500 earnings growth, almost all of that can be explained by these top 10 stocks in the S&P, which are primarily tech, media, telecom, discretionary, high growth stocks. So there's always nuance to the valuation story in stocks. I don't think a 21 PE on the S&P is exorbitantly expensive. In fact, it's cheaper than it was at the end of 2021. The counter to that might be we have much higher interest rates today, so that should be a higher discount rate applied. So we shouldn't be nearly as high of a PE as we were then. But to me, this is not euphoric territory by any means. You just, as a long-term investor, maybe keep in check your S&P 500 performance expectations. I think it's kind of reasonable. Maybe looking at a 5-7% compounded return versus the 12, 14, 15% that we've seen since 2009.
Gotcha. So talking about multiples, interest rates are higher now. Investors are looking for returns, and the bond market is now yielding highest than it has in quite a long time. So is now the time for investors to rotate into, say, a bond ETF, for example?
Well, whenever we're talking about fixed income and bond stuff, it really comes down to an investor's risk tolerance. So we've got right now you can earn 5.1% on the aggregate bond index. So like the iShares AGG ETF or the Vanguard BND, those are just your broad investment grade, high quality treasury corporate bond ETFs. And so those have a yield to maturity right now a little above 5%, which is very strong compared to the last decade plus. Now, I've seen the chart of the S&P 500 earnings yield compared to the rate that you might get on treasuries, and they're kind of using those to say, oh, you should probably be in bonds. But once again, there's kind of a quirkiness to that. I take the approach of comparing the potential stock return to bonds using the equity risk premium. And this gets a little wonky. I used to teach here at the University of North Florida finance, so I kind of put my professor hat on sometimes. But if we look at the equity risk premium, and what that is we take the earnings yield of the S&P, which is just the inverse of the PE ratio. So right now, that's about 5%. If you have a 20-time earnings multiple, that's a 5% earnings yield. So we take that, and a lot of folks are comparing that to treasuries right now, which are getting close to 5%. And they're saying, oh, they're about even, so the balanced risk, you can earn 5% in stocks, earn 5% in treasuries. But it's different because with stocks, a share of stock on itself is a claim on real assets, meaning that shares of companies are going to grow earnings if inflation grows. So think of it this way. If you're a company and your revenue is, $100, we have inflation of 10%, that's going to go to 110. If your expenses are 50, that's going to go to 55. You've just grown your profits by 5%. So that is basically an inflation hedge. So what we're looking at here is we got to compare the earnings yield on the S&P to the TIPS yield, which is the inflation adjusted treasury rate. So right now, the TIPS yield is like 2.3. So if we have an S&P 500 earnings yield of 5 compared to 2.3, hey, it's still positive. So that's where you may want to come down on whether you should be long stocks or bonds. It's not as if bonds are like that screaming deal right now. While that equity risk premium of 2.3% is not all that high, it's still positive. For perspective, that got up to like 12% in 2011. So that basically should tell an analyst or an investor, stocks today are nowhere near the value they were compared to bonds in the early 2010s when yields were very low and the S&P 500 PE was like 13. So a lot of information to say that you shouldn't be making wholesale changes to your portfolio, but there's certainly opportunity to earn solid inflation adjusted yields in both treasuries and in corporates right now. So for folks like nearing retirement, in retirement, they should definitely make sure that, they probably have a decent amount of fixed income right now because, you're getting some really solid yields. And while it's scary to see like interest rates go up on any given day and bond prices go down, you have to realize if you just hold to maturity, you're going to get that 5%. Even in something like AGG, which has a duration of 6 years, if you buy AGG, the ETF today, hold it for 6 years, you're going to get that return of 5.1%. So it's not like it was in 2020, 2021, where there was just extreme interest rate risk. Even if interest rates rise 1% from where they are right now, that's not going to have nearly the same impact as it would back in 2020 and 21 when interest rates were on such a low floor. So it's an entirely different environment today in the bond market world versus 4 or 5 years ago.
But I want to talk about, so we do have investors that are very much focused on fixed income. It could be retirement, it could just be their strategy, right? We know that they are very much interested in capturing that yield, whether it's via REITs, bonds, wherever. But if we're talking about bonds specifically, would you be recommending at this moment in time to have those investors focus on the front end of the curve, the back end of the curve, or maybe even the belly? Which would you say?
Well, for that, I think you got to look at what's going on in the TIPS market too. Like we have a 2.3% TIPS yield on the 10-year, maybe a little more than that now, and then on like 20 and 30-year treasuries. So, I mean, those are historically pretty good. You have to go back to like the year 2000 to see significantly higher TIPS yields than that. Given that, and that should tell you that there's decent value in the bond market today. That being said, we have a very flat yield curve. We have this front end of the curve probably going to hang around the low to mid fours for a while, and the highest you get further out is on the 20-year, which is a little above 5% right now. So while there has been some yield curve steepening in the past few months, got to about 40 basis points, it's pared back from there. I would just be cautious about parking it all in a money market fund or a very short-term treasury. Like that's the feel good kind of safety play right now. Just because you can see that those are pretty solid yields, and we're not going to have a string of Fed cuts, it looks like, anytime soon. So that would be the safety trade. But if you want to step out on the curve into some duration, you should earn positive, real returns on that. The only the difference now compared to the last cycle is that we have a positive stock bond correlation. So you probably won't be getting that diversification benefit of bonds going up when stocks go down that we saw in the 2010s. That's just the nature of when you shift from a deflationary world to an inflationary world. You lose that stock bond diversification benefit. But the upside on that is you get higher yields. So that's always the trade-off. When we were in the 2010s, we had ultra low yields. So bond investors were hardly getting anything, but they were getting the diversification benefit of, if stock prices, puked in a certain quarter, chances are that the bond market would catch a bid and rise. And so you would get a buffered return there based on the bond sleeve outperforming. So there's always a give and take. But you never know. It's like we could have a macro shock come up at any time that causes a flight to safety and treasuries again. We saw that, at times last year, like around the yen carry trade unwind in early August. I write a lot about how that was kind of a key date in markets, the August 5th low. Situations like that, like all of a sudden people start buying treasuries again when there's fear. So that can certainly happen on kind of a short-term basis. So I would say that for investors who, don't have an ultra long time horizon, there's certainly much better deals in the bond market today.
Yeah. Mike, I want to play a quick game with you, a duel of ETFs, right? This is an ETF show. I want to get your take on the SPY ETF, right? Market cap weighted, tracking the S&P 500 versus the RSP Invesco's equal weight ETF for the market trend going forward. You kind of sprinkled some information earlier in this episode about tech earnings and things like that. So I feel like I know which one you might go with here, but if you had to choose between the two, which one would you pick and why?
Yeah, so I write a lot about the different sector breakdowns of ETFs. And yeah, I would certainly say the RSP would certainly do better if value catches a bid here. And we've seen a little bit of an outperformance from RSP in the last couple of weeks. I mean, hardly anything on a long-term chart, but you may get a little bit of safety there if we see further rockiness in the tech trade for sure. You look at SPY with a 30% weight in the tech sector versus RSP, which is like 10 percentage points less than that. So definitely more value, cyclical oriented in RSP. So maybe longer term, I would favor RSP. Shorter term though, it's like we've had more than 2 years now of this outperformance from the cap weighted version. So from a momentum point of view, if you're betting against SPY versus RSP, you're kind of going against the trend. And as a CMT guy, I have to kind of check myself when I want to say, oh, go into RSP and not SPY, because the momentum factor can be so huge on a short-term basis. And time and again, we've seen the Mag 7 when they stumble, it's like one of them kind of gets off the mat and eventually starts bringing all of them back up, and there you go, you have SPY outperforming again. So yeah, I would say longer term, RSP is probably your better bet, but you can't discount the effect of momentum, and we might still see another strong year for the S&P 500. I feel like you still have a lot of folks who are just wishing and praying for equal weight to start outperforming on a multi-quarter basis. But I would like to see a little more, a few more technical signs of that to really confirm it.
So you mentioned being a CMT, looking at these two ETFs. Do you ever look at them and try to use them as a prediction factor as what to expect ahead?
Yeah, so you can compare ETFs on their chart and take a look at relative strength lines. Also, take a look at momentum trends, like with an RSI oscillator or like a MACD kind of thing. It's definitely something that active investors, I think, should take a look at. I just wrote an article today looking at AppLovin. Not usually kind of in my purview, but I noticed that the relative performance of the IGV software ETF versus SMH, the semiconductor, that's been telling a very interesting story in the past year or so. So first half of last year, we had chip stocks, like your NVIDIAs and SMCIs, Broadcoms. So those have been outperforming software stocks for the first half of last year. But then we saw a shift in favor of software, which is more like AI adjacent versus AI direct. And so software began to outperform, but software stocks then peaked in December, and they've been kind of struggling since then. So I think that comparative analysis of one ETF to another is a useful exercise, especially for active investors when they're looking to overweight certain industries. There's an ETF for everything these days. So a lot of times you can compare two kind of, close, two related ETFs like SMH, IGV at the industry level, and try and find some alpha there. Or you can do like the broad macros kind of perspective and look at SPY versus RSP, or SPY versus AGG, the stock versus bond perspective. So definitely something I like to do in my analyses. And for any of the folks who read my stuff, they know that I tend to start my articles looking at things from that perspective, then dig into a stock or a specific ETF trend that I see.
Well said, Mike. Let's go ahead and leave it there. Thank you so much for your time. Everyone, Mike Zaccardi, if you're not following him already on Seeking Alpha, make sure you go do that. He is pushing out articles all the time. I saw recently you just put one up with ARCW, so I haven't read that one yet. I'm about to, but I know we have them on another episode. And if you haven't watched that episode, go check that one out as well. And everyone, we'll see you here in the next episode of ETF Spotlight.